Welcome to the Broken Pie Chart Podcast, episode 379. I'm your host, Derek Moore. With me once again is Shane Skinner. Mike Snyder is on assignment. He's not really, but I like saying that. All right. So, Shane, you know the sell in May and go away? You know that theory? Well, hasn't been working the last couple of years. So May performance, it's on track to be up over 4%, almost 5%. And looking at a chart, this is from, who is this from? This might be from, who is this from? It's not from me. So anyway, I'll give credit. Isabel.net, I think, had this chart. Yeah, May performance, last 3 years, greater than 4%. Sell in May has not worked. And you look at this.
Yeah, it hasn't. And look at 65 through 80. Is that where the notion came from?
I mean, maybe, yeah. I mean, if the audience can't see the chart, but there's a bunch of bars that are all negative. Yeah, 60. I mean, I would say starting in 60 and you go through, I mean, I'll estimate here. The scale's tough, 83. Yeah. Not great. It's been fine. So imagine an investor sold each of the last 3 Mays and then waited to get back in. Missed out on a pretty good month. I don't really have anything else to say on this. Just, I mean, it works when it works, I guess, right?
Yeah, monthly seasonality. You know, the other one we always hear, right, is the Santa Claus rally. And I think we talked about it before. It's like, you just don't know. You just don't know. This stuff doesn't necessarily behave one-to-one. I don't know. It seems like, again, what is this 4% you're saying at least? You've missed the past 3 years if you sold in May and waited. You missed at least, I think, 4%.
I think at least. It looks like some of these are more like 5%.
Yeah,
last year was 6%, something like that. Yeah, I mean, the problem with market timing, this isn't any newsflash, but you have to be right twice. You have to be right on when you get out, and you have to be right on when to get back in. And if you can't do that, it's tough. And I will tell you also, in Jay's book, Buy and Hedge, he has a chart in that book. And that book is, I mean, at this point, when did that come out? 2013, I think. And it was a chart of, I think, the worst months and the best months, and the worst days and the best days. And what you find is best and worst days ever in history tend to be clustered together. Like 2008, we'd have days that the market was down a lot. But then you have days when the market was up a lot. You remember in Liberation Day. So what was that? Was that all the way back? Yeah, that was this April, right? Or was that? No, that was a year ago, April.
Yeah.
A year ago, April. Yeah, in 2025.
Yep.
And we had some bad days, but we had that day where Trump comes out with the tweet, buy stocks, and then the stock market was up like almost 10%, which is a multi-standard deviation move. So yeah, don't know. All right. Next thing I want to go over is bond versus equity valuations. So this is a chart from Urian Timmer over at Fidelity, and he's got this chart, and he's basically talking about how, I mean, the genesis, I believe, is higher interest rates. Do they matter for equities? And he put together this chart. All right, I take a little issue with this because he has 1960s to 1990s and then 2022 to current. He's got a trend line, 1960s to 1990s. And it's like, why don't you just put in 91? Where's 91 to 2021? Okay, maybe he didn't want to put it in because we essentially had zero rates. But if you invert the bond yield, you come up with a theoretical PE. So if rates are 5% and a bond is, priced at par at 100, it's got a theoretical bond PE of 20 times the 5, right? So when you look at this chart, you would say, okay, we're at what, 21.9 times forward right now. And I think we are at, what is this? 22.1 forward PE on the bond. And I guess what he's trying to say here is when the inverse of yield, the bond PE is lower, returns are lower because if rates are 10%, your theoretical is only 10 times, not 20 times. So, okay. I don't know why he got rid of all the other areas, but yeah. I guess the point is, Shane, that if yields go up enough that it hurts equities. I guess that's what he's saying here.
Yeah. Yeah, I think that it basically becomes more expensive. But when you think about how so much of the market is priced and the pricing theory, right, going back to college here with finance courses, the CAPM, right? Interest rates are a huge role in that, right? And the cost of essentially capital, or what it yields to, loan money on bonds or treasuries, seems to have a direct impact on how stocks are then sort of priced on a price to equity.
Well, it goes to net income. So if your capital asset, the capital asset model, the CAPM, I think you're referring to, your cost of capital. So what can you borrow money at, i.e. issue debt? What can you, and you can issue equity, you can issue debt, and there's different ways to sort of value the cost of equity. But yeah, that matters. And that's one of the reasons why I think small caps have lagged when interest rates were higher, because that disproportionately affects smaller companies because their borrowing costs are higher. It doesn't affect Apple as much. Apple doesn't have to borrow as much money compared to small caps. And I think in some ways Apple borrows money because it's more convenient and it's more tax, neutral or positive to do that. But okay, yeah, I mean, there used to be a theory. Is it the Fed model? You and Timmer may have said this, and I got this off his Twitter feed. But the Fed model kind of has this deal where you look at bond yields, the inverse, the PE on a bond versus the PE on equities. And anyway, okay. So I don't think bond yields matter. They haven't mattered to equities yet. And maybe they matter when they matter. But I would also say that the rate of change in rates is not that dramatic this time. It's not like we're going from 75 basis points on the 10-year to 5%. So the rate of change definitely matters more. All right. It was bound to happen. This is from Bloomberg Intelligence. There have been 21 different filings for ETFs around SpaceX. So, for example, the ProShares Ultra SpaceX ETF, these aren't out yet, but they're filed. The Direxion SpaceX Bull 2X ETF, the Direxion Daily SpaceX Bear 2X. Let me see what we got. We got some income ones in here. Let's see. I see a Yield Max one that's listed, option income strategy. I'm sure we've talked about the volatility on SpaceX. It's probably going to be high, which means that, there's like a yield boost from Granite shares. There's even an auto-callable ETF. All right. So not surprising, Shane. We have all these products built around the sphere of SpaceX. So, I feel like, should we do a strategy? Should we create like a SpaceX strategy?
I was actually thinking you do one that is everything but SpaceX once it's in the index. It's a little controversial take, but I'm actually wondering, and I think we've got some data later on to get into about the IPO fade, supposedly, if I see correctly here. And I don't know. There have been rule changes, which, listen, don't get me wrong, there are rule changes all the time across the industry. So, I'm not necessarily griping, but there have been rule changes that have taken place at, the NASDAQ, for example, on the ability for SpaceX to essentially be added to the index, right? And, you could sit on either side of the fence, in my opinion. You could argue for it. You could argue against it. I think the concerns revolve around the revenue, right? Like this valuation they're seeking to raise capital at versus their current revenue versus expenses, I don't even think they're net profitable yet. I could be wrong though.
No, they're not. They weren't profitable in 2025. They did show a slight profit based upon their S1 in 24. So
it's still, dude. We've seen Musk do this before, right? Tesla, for the longest time, it was hated on. A lot of people didn't like it when it was added to the indexes. I don't think there are people very opinionated around this in a lot of ways because of Elon Musk, I think. And so, it's going to be interesting to watch either way. But I think you actually take it out of whatever index you have for a month. That's the bearish take, I guess, on SpaceX.
There's been some reports here. I'm looking at a Forbes article. So they talked about forcing changes to indexes. You mentioned that. We've talked about it. It apparently is going to go in soon after the IPO into the NASDAQ 100. But it's, let me see. I think they're going to do a float adjusted. This is from Forbes. And let me see if I can read this. Yeah, so they're going to rewrite the rules. But I believe since it's a small float that's actually being made public, and they're going to do an adjusted weighting based on the tradable float. So a lot of the shares are they're not going to get traded. They're closely held. They're Elon stock, right? So I think according to Forbes, if SpaceX has a 4.3% float, they're going to use a three times multiplier to weighting calculation. So they'll treat it as having a 12.9% float for index weighting purposes. Doesn't mean they'll be 12.9% of the index. According to Business Insider, they could see an overall weighting of approximately 0.47 to 0.70 of the total index because of the overall scale and market capitalization of other. Okay, so they're going to do something with the weighting. And so in other words, you're not going to have a $2 trillion weighting
fair
in the index.
Right.
Okay?
It's going to be 0.5%, you said there roughly. That's sort of middle, like 0.5, 0.6% was sort of the middle.
Yeah, according to what I say, Business Insider, and then Forbes had some stuff. But let's get into it now. There was somebody, let's see, this is from RIA Advisors compilation, IPO research from Science Direct, MIT Sloan, and Recede Investments. Okay, so they put this together. The IPO fade, percentage change from day one peak by cohort. And this is the average price path from intraday peak, day one, through day 20, which is week 4. And they break these down into hot market IPOs, all IPOs, large cap IPOs greater than 5 billion, and cold market IPOs. So hot market versus cold market, it means everybody wants the IPO. Cold market means nobody wants it. So, I mean, you look at hot market IPOs, this is percent change from peak. So the high on day 1 through day 20. If I'm reading this right, the average is a pullback of, what is that, 27%? Something like that?
Yeah. Yeah, that's about roughly. I'd be interested to see market cap, like sliced it up even more.
Yeah.
They have that. But this is...
Well, I have a problem with this chart. Number one is it's not saying the time frame. So when is this measuring it from? To your point, market cap, I'd like to see, like, what's the average market cap? Or, I mean, the large cap IPOs, it's greater than 5 billion. So those don't pull down as much. I think those, I'm estimating, I'm eyeballing it like 14%. So let's kind of go with that one for a second. I mean, there are some people who say, I'm going to wait to buy it. And other people say, no, I want to be part of the IPO because I think it's going to be a good price. So,
right. Like you said, there's not a huge float either, and that there are people who are going to want in on what is available publicly when it's available publicly. Very Very interesting. I just looked up Tesla IPO, or at least what I've got here, June of 2010 on a split adjusted basis. It opened at $1.27.
Okay. So actually, I can look at this. I can actually look. So tell me the exact date of the IPO.
I am.
At one of these days, Shane, we'll actually do this before the show rather than doing it live.
I know.
But give me the exact date of the IPO, because I can look it up on Bloomberg and get very specific.
Okay. I'm seeing the exact date was June 29th, 2010. So at least what I'm seeing on my chart here.
Okay. So then let's call it 30 days later. We want to see what the price was. Is that fair?
Yeah.
Okay. So that's, what are we going to say? July 29th, 2010. If we look at that. Okay. Total return minus 14.81%, according to Bloomberg.
Yeah.
629 to 729, 2010. So.
Yeah, on a split adjusted basis, opened at about $1.25. It peaked at about $2. Okay, so you ran 75 cents. So, these things can run hot initially too before pulling back.
Well, here's the crazy thing.
It hit a low of $1 5 days later after IPO.
It's max drawdown on a closing basis, minus 33.87%.
Yeah.
June 29th to July 7th, 2010. So, yeah, that's an interesting one. I'd like to look at, let's not do it now, but I'd like to look at Google's, because I feel like Google was an exception where it was pretty firm. From memory, I think they did a Dutch auction too for the shares. It was a little different and it was controversial at the time. I'd have to go back and look. So, okay. So getting back on point here. Yeah. Like you look at some of this research and like any stock, it doesn't necessarily not go down, but it could go up. And I think it is going in the index in the NASDAQ 100. We talked about it last week of why it may not go in the S&P for a bit. I also think the S&P they would have to change their rules based upon the float. I don't think there's enough of a publicly traded float to meet the criteria, but I could be wrong. All right, let's talk about the day 100 in the market. You found it. Okay.
I had to send it. This is a pretty incredible stat.
So my memory is good. Okay.
Yeah,
I'm happy.
Yeah. August 19th, 2004. And Google hit a low the day it IPO'd. It looks like of about $2.40. It opened at $2.50. And it never touched 240 again in the entire history of the stock. So that's a good example of a stock that it IPO'd. It came back down to about where it opened at a few weeks later after IPOing, and that was the last low.
Okay, 30 days later, so I pulled it on Bloomberg now, 8/18/2004, came, I think this is split adjusted, $85. And went to 117.49 by September 17th. Here, I'll make it the 18th just to... Yeah, so it was up over 38%. I mean, the worst it did, if I'm looking at this, was through the 3rd of September.
Yep, that's what I'm seeing too. The 2nd, 3rd, and 4th bottomed.
Only up 17.65%.
Only up that much, right?
So it's really never been... Okay, it's never been back below its... here, I'm going to look at 2025. I'm going to pull up the chart here. I'm glad you found that, because I was thinking... I thought Google was definitely the exception there. Yeah, if you look at a long-term chart... Now, what's interesting is you're looking at... So you're right. The adjusted price was $2.12, 2.1271. So when you're looking at your numbers and I just said it was 85, you're not wrong. I'm not right. It's just the period I looked at, all the later splits hadn't happened yet.
Right.
So it still showed, no, that's right. Okay. How did I remember that? Like it was totally off the cuff. I'm like, I don't think Google went down after its IPO, but Tesla did. So there's the inverse. Like one was up over 30%, one was down over 30% a month later. So how about this, Shane? Closer to the IPO, let's do a guesses. Mike will be back too. So we'll do like a dollar for charity or something. I don't know what we'll do. Okay. Day 100 though, Shane, has come as it usually does in the month of May. And I know you're familiar with this, but when it's up nearly 10% year to date. So the day of this chart, this is from Brian Dietrich. So that's why you had to say nearly 10% because it was 9.9%. Day 100. Good news is bulls are smiling, according to the title of this. S&P performance after day 100 is up greater than 9% year to date. So the full year return average is what? It's missing from the chart. That's okay. The rest of the year return on average is up another 8.1%. The median is up 11.1%. 86.4% of the time, the rest of the year return is positive. The exception is 87 because you had the 20% crash. The rest of the year it was down 14.5%. There were 2 years that were flat, 83 and 75, and all the other years were up. So do you see? And then the full year return, like most of these, with the exception, they're all green.
No, 87 still. You finished up 2% on the year.
That's right.
With the flash crash. So you basically were up, 19.4% there after 100 days. So in May, you're up that much. You get the flash crash that basically knocks you down a net 14.5, still close positive.
The rest of the year, but you closed 2% because the difference there. Yeah. No, that's right. So what do we have to worry about? It's going to go up, right? I mean, I'll let you know when I know, but this isn't surprising though.
But that's why you hedge, right?
That's why you hedge.
If hedging's cheap, right? And you've got a decent return, it seems logical here. You never know when an 87 is going to happen, and maybe it'll never happen again. But that's the point. You don't know. And the rate of return for the full year on these, we got to get the average on this later because this is impressive. And I mean, this is hard to argue against. It really is.
87, I wasn't in the markets back then, but I do remember 87. I remember it happening. And, the difference is, there's all these circuit breakers that just weren't around in 87. For example, there's, I'm doing this from memory. I think Schwab has an article about this though. Yeah. According to Schwab, what are stock market circuit breakers? Great. So they have these in there. Level 1, if there's a 7% decline before 3:25 Eastern time, trading halts for 15 minutes. If it occurs after that time, trading does not halt. So 7%. Level 2, a 13% decline before 3:25, halts for 15 minutes. If it occurs after that, it doesn't halt. Level 3, a 20% decline at any time of day, trading halts for the remainder of the day. So, there are some curbs in place. I don't know, here's the question. Would it really help? And we've had futures go lock limit. We've had 15-minute halts, and those are adjusted. They used to be lower, but I think those have been adjusted. So, all right. Anyway, let's get back to our stuff. This is from Goldman Sachs, and $600 billion in U.S. equity issuance in 2026. says it grabs the attention and feeds the doom narrative, but relative to the total value of U.S. equities, it is not that large. Big number, yes, but scale matters. So I guess if you put, I wonder if they're including in the 600 billion, the 85 billion estimated that SpaceX will raise. Yeah, probably. So, 2026 is estimated to be higher. It's the highest anywhere going back to, I'm going to say 21, I think was higher. But I think the point that Goldman Sachs is making here is, it seems like it's a really big number, but as a percent of the total Russell 3000 market cap, it's not that much. In fact, if you go back to, God, the scale on this is really, it's tough to see which one it is, but I'm going to say 10, 9. Yeah, 2009. And this doesn't say whether it's IPOs or equity issuance. Weren't companies issuing stock in the late 2000s to generate funds?
Yeah. Yeah, they were. I remember studying about that in school. The other thing is, if you notice, it's really come down quite a bit, but it looks like it might be on the rise to breaking back out. I wouldn't be surprised if we see it pull back up to 1.5%. And remember, this is going to come back to the rates thing. Think about rates. Wouldn't you say that this might have an effect on people's debt to equity decisions in terms of, or I should say companies' debt to equity management? If you find yourself in a higher rate environment, it's very possible that you might see more equity issuance.
Yeah, if you issue equities, and some companies do it because of stock-based compensation. We saw that in the 2000s, late 90s. Share counts were going up. But no, you're right. Like if it costs you 10% to issue debt versus costing you, 4% to issue debt, there's a decision there. And you say, well, maybe I'll just dilute the shareholders a little bit and do that. We don't have enough stocks, though. And I'm going to ask you, don't look it up. How many stocks are in the, I can hear you typing, Shane. Don't look it up. How many stocks are in the Wilshire 5000 index?
It's got to be 5,000, right?
Nope. It is, according to Barron's, approximately 3,400 stocks. And when it was originally created in 1974, it tracked roughly 5,000 companies. But you have mergers, IPOs. In the peak of the late 90s, the index held over 7,500 stocks, and that's according to Wilshire indexes. So a lot of companies are remaining public. You've had mergers, acquisitions, those consolidate, two tickers into one, those types of things. And a lot of companies are remaining private for longer. So, yeah, we need more stocks.
I agree. I also, so it's funny you mentioned this because it ties back into the SpaceX ETF thing, okay, and the space ETF thing. I don't know if you saw this. There are now more ETFs than stocks in the U.S. According to Morningstar, originally reported by Bloomberg, I believe, last week, there are now some 4,400 roughly exchange traded funds listed in the U.S., which has surpassed the number of American public companies. There's arguments that we don't have to get down this rabbit hole if you don't want to, but we all know, ETFs provide a variety of flexibility in terms of tax and or offerings and exposure that you might not be able to get through just individual companies, or it might be more complex doing it yourself.
Well, active and passive. For a long time, passive ETFs were the thing. Active was a very, very small share. One of the arguments against active ETFs was, unlike a mutual fund, which is forced to disclose their holdings, once a quarter, an ETF, well, they disclose their holdings like every day. You know what's in there. And so some active managers who were running strategies said, well, no, I don't want to tell everybody what's in there. won't people just follow it, or it will give away some of the secret sauce, or it will cause me to trade more, cost more. But no, I mean, active is now a thing with ETFs. And I think there's pricing power in active too, that you can actually charge a little more. But for all the tax benefits, ETFs are superior to mutual funds for any number of reasons. So yeah, but we need more stocks. We need more individual equities. Like, come on, guys, let's go public. I mean, we'll see it with Anthropic, I think. If OpenAI can get past its legal stuff, I wouldn't doubt if you see, because how else do you get liquid if you're an investor? Like if you're an early stage investor in those companies, you either have to sell in subsequent rounds at higher valuations, where if you're allowed to sell your share to somebody else or find another buyer. But that's a great way to get liquid. Like that was the thing. When I remember this in the 90s, people worked at these companies. They were hoping and praying for an IPO so they could all of a sudden realize the value of these shares they've been getting for years. So, all right. Continued earnings growth should drive continued equity market upside. This is from Goldman Sachs and CompuStat. And it's S&P price and earnings. No surprise here. The market over the long term tends to follow EPS growth. Conveniently enough, though, Shane, do you see that the solid blue line? So year-end 2026 target from Goldman Sachs now is 8,000. If I'm looking at this right, and it was probably April of this year, was their target, year-end target, only like 6,500, 6,400? Which is why these targets make no sense, because the investment banks, if markets are down, they lower their targets. If markets are up and doing well, they raise their targets. Like, thanks. Just give us a target and stick to it.
Yeah, it's a bit, I don't know, the adjusting intra year. I guess I get it. We're approaching the end of Q2. So they're going, hey, we're halfway through. This is our new take. But I'm with you, sort of anchored to what your original was. You can provide updated commentary, but I don't know. I also think let's be real. We've said it time and time again. This is a very hated market, hated rally.
It is.
Will, and there's a lot of people. I mean, before, I'm not going to get into Dell and Intel unless you want to. There's an interesting chart I sent over.
We'll get into it later. Yeah.
Like you're, with this space thing, that whole sector has ran like crazy the past month or so. And, who knows what it's going to do in the next month or two, or next 6 months, 12 months, right? Nobody. But it's, if you're looking at this from fundamentals, in some ways you're probably scratching your head going, how? And yet you're seeing so many of these names take off, right? Or again, names like Dell and Intel, that who'd have thought in 2026 we would be having this conversation about both of those companies at the same time.
See, I don't on a valuation basis, I mean, this is not the 2000s or the late 90s. I mean, you look at the earnings growth.
Oh, and yeah. The PEs are nowhere near. I saw a screenshot of some big name. Cisco was like, what was its peak in 2000?
Oh, it was probably a forward 90 PE or forward 100 times. Yeah.
It was huge, right? I think it was over 100. And it's like, I don't think we see a lot of the leading names right now trading at that.
Well, here, I'll give you, here's an interesting thing. I'm going to give you three names: Costco, Walmart, and Nvidia. You already know what these are because you can see the chart. But I'll give you these three names. Nvidia, and I don't know where, this is from Charlie Bolello. He has Nvidia at a 16.8 1-year forward EPS, a forward PE ratio. I don't think that's I get something different. According to Bloomberg, it's 21 times forward 12 month. Regardless, the point is Costco, he's got it 44 and a half times forward PE. Walmart is 36.04. So it's like if you didn't see this chart, Shane, or if you just showed this to somebody and you said, show me Nvidia, show me Walmart, show me Costco, they'd probably invert it. They'd probably say, well, Nvidia first. Are you sure that's not a typo in Walmart? And then Costco, you'd assume would be the lowest. Nvidia on a forward basis is cheaper than Costco, cheaper than Walmart. I'm telling you, some of these big tech names, it's almost like the analysts don't really believe it. They don't really believe that growth could be that high. So they're sort of underestimating some of the growth. And when I say the analysts, their forward estimates are raised on EPS, earnings per share. But I'm saying like the institutions, like they don't really believe it. Why are they not buying Nvidia up at 21 times earnings and selling Costco and Walmart? Like that's an interesting pairs trade. I'm not telling you to buy any of these or short any of these. I'm just saying like on a valuation basis, if this was the 2000s, Nvidia would be at 90 times forward and these other ones would be, 20 times forward. It wouldn't be like this. It's just weird.
It is. And, one thing that's interesting to observe here on Nvidia's, we're only looking from probably 23, 24, from 2023 till now. But notice anytime there's a steep, sharp drop off in Nvidia's PE, their forward PE, it usually bases and then goes higher. And so this is one of those where, like you said, they're so conservative, and I get it. I think that like everybody's almost like waiting for the other shoe to drop, right? And until those numbers come up or until the market decides otherwise, I wonder if they're going to continue to be cautious on their forward estimates for that. I'd be interested to see the whole like SOX index or like the top 10 names at some point. Maybe we can pull that for next week. That would be interesting to see.
What do you want to know? The SOX, the forward PE? I can get that in 2 seconds. Give me
forward PE of like the top 10 or top 5.
Well, why not just the whole index?
Or the whole index even, yeah.
Yeah, so the forward price to earnings on the SOX index, the Philadelphia Semiconductor Index, 30.43.
Almost double, just under.
Earnings growth. Earnings per share on the SOX index is estimated to grow 94% year over year next 12 months. 36% after that, 13% after that, year 3. So they're forecasting almost 100% growth. Sales per share is projected up 38%. So when you look at EPS growing by more than sales, you're saying there's some operating leverage there, but also their margins are expected to be really good. Here, let's do this on the fly. What is the SOX index estimated forward margin? Well, you take the EPS of earnings per share of 422.13 divided by their sales per share, which is 1153.26, spot 26. And they've got, 36.6 projected net profit margins over the next year. S&P is 15.5. And the S&P's, here, I'll pull up the S&P just to give you the exact forward PE, but, the S&P, their forward PE is 21.5. So double the margins, not double the forward PE. See, I got that quick for you, Shane.
That was perfect. But it's interesting. Is Nvidia number 1 in there still? I would assume so, right?
Well, if you look at, so what's the iShares?
SOXX.
Is it SOXX? Yeah. So SOXX, if I look at that, because I was going to say the SMH, but the SMH is not weighted the same. Like the bigger companies in the SMH are
I
bigger.
knew it. I knew it. Micron, 11.04%. AMD, 9.5%. That's one that's ran recently, just took off. Broadcom.
Intel.
Yeah.
Above Nvidia. Look at that.
Intel and Marvell. Look at that. So Nvidia now in the SOX index, in the semi index, 4, 5,
Is sixth.
6. Incredible. I mean, so is this one of those situations where
SMH, by the way, it's 15.5. So, and Micron is only 7.3
Okay.
in SMH.
Okay.
SMH is the Vanna semiconductor. But no, I think where you're going with this, and tell me if I'm wrong, like it's been a lot of the names that have all of a sudden taken the baton from Nvidia as far as having this thing really run up. Like Nvidia is not doing all the weight like it once was.
look at Texas Instruments?
Yeah.
Ninth on the list, Qualcomm, 8th AMAT. I mean, yeah, you nailed it. It's really not been just NVIDIA at this point. And again, it's almost like NVIDIA has become the flagship in this space, almost like an Apple, right? Like in this area of the market. And, with that, it seems to be a little bit more, I would say the forward, it's a lot significantly lower than something like Micron or AMD right now.
Now the SOX rebalances quarterly. I think they do a June rebalancing. So given where Micron is run, I wonder if they make an adjustment and it's not number one anymore. So I think I just looked it up.
Yeah, we should check that.
Let's see. Okay, so Filex Semiconductor rebalances quarterly with changes taking effect at market open on the Monday following the third Friday in March, June, September, and December. So we'll have to look into that more. I mean, but your point, though, you sent over a chart of Dell versus Intel. This is from Charlie Bolello. And the 2026 returns, I'll just read these off. Dell, up 227.8%. I don't know when the end date is, but I imagine it's pretty recent. Intel up plus 224% year to date. I mean, Dell and Intel, these are companies that were big in the late 90s. Like, it's fascinating to see these companies. And think about Intel got dropped. Was it the Dow they got dropped from?
I believe so, yeah. Yeah. And you, again, it's just, who would have thought? I mean, there have to be people out there that bought the top in the .com era and have held this whole time. There have to be. Maybe not a lot, but I mean, can you imagine having held that whole time? And here you are.
Well, I mean, okay, so Intel was taken out of the Dow November 8th, 2024. Nvidia was put in the Dow. So it's not like you really lost. And if I look at, the price of Intel versus Nvidia since it came out of the Dow, I could actually do this in Bloomberg. If I do it in 2 seconds, I'll tell you. If not, I'll come back to it. But yeah, you did okay getting, if you own the Dow. Dow's a weird index anyway because it's price weighted. So if you, like when Apple did a 10-for-1 split, their weighting in the Dow went down because I think they went, from 1,000 to 100. I forget what it was. Maybe it was 7-to-1 or something like that. But I remember they did and the Dow does, unlike market cap weighting, which is the S&P, they actually do price weighting, which is weird because if you do a split, it's like a 10-for-1 split means you 1/10 your thing. Okay, let me look it up here. So since they took Intel out of the Dow, were you better off with Nvidia or better off with Intel? Okay, Intel's up 391.77% total return. Nvidia's up plus 58.95. That's funny. See that? Even when an index tries to pick winners and losers, doesn't always work. It's not
You
always
just
work.
never know. Yeah, it was good. It's a larger holding, like we said, in SOXX currently. Now we'll see what happens
It
when we
is.
do the rebalance. But yeah, again, it's just you just don't know. So this goes back to getting into the Tesla thing or the SpaceX thing. I'm glad that you went through and essentially did the math and called out how we're looking at it being between 0.4 and 0.7% of the NASDAQ. Whether or not that's too much or not enough, I don't know. But it's good to know that it's not coming in and instantly going to be at the top of the list there necessarily of holdings or weightings and have that much of an impact on the index if it were to experience in a drawdown after IPOs. So.
All right, let's look at. So you had sent it over as well. So China Internet ETF KWEB 2026 year-to-date returns minus 21.15%. The NASDAQ 100 year-to-date plus 32.57. But okay, I know the Chinese Internet Index, though. I mean, that's Alibaba. It's Tencent Holdings, NetEase, and so JD.com. These are not necessarily, what I don't see in here is the storage, the memory, or semiconductors. So I don't know. I don't find this that interesting, but you did. So what were you thinking here? I say that sarcastically, but go ahead. Tell me what you see here. Shane, I think you hit the mute button, by the way.
I think sorry about that. I think there's been the argument that, emerging markets, right? Which if you go look at what's going on, I think it's in, is it South Korea right now? That's got the crazy run taking place and their market. And specifically, I think like the semis and AI space, we talked about, what was it? Foreign markets, right? Is it better to be in them? Is it better to, you don't know. And this was just interesting because for a long time I've thought, okay, if tech does bad in the US, sometimes, you might rotate out into elsewhere. And I just found it interesting that while tech has been crushing it in the US this year, it's all but down, 20% here, year to date in China.
So broader China, I look at the FXI, which is the iShares China Large Cap ETF.
Okay.
That's down almost 12%.
That surprises me.
Compare that to two emerging market. So EEM up almost 22%. VWO, which is the Vanguard Emerging Markets ETF, only up 9%. They must not have some of the same holdings. So maybe they don't have. Oh, you know what? I read something from Eric Baltunis on this. I think VWO doesn't have Korea in it. And, Korea has Samsung, Highlinks, and there's something else, which is why that's up. So that would explain. Look, we joked at the end. We didn't joke. We were just saying, like, if you're a contrarian at the end of 2025, what do you buy? You buy oil. If you're a contrarian right now, and I don't have any basis to say whether it'd be interesting to buy China here, but China's kind of not real. It's out of favor. And it's been out of favor. If you look and you say, well, what has China done since the beginning of, 2025? I mean, KWEB is flat. FXI is up 20%, which means it probably had a pretty good 2025, if even after that. So, but it's trailing emerging markets. So I don't know, I don't know what to tell you there.
Yeah, it's interesting. I just
I'm still thinking about the Google thing. The Google,
Oh, isn't that nuts?
Never fell below its opening day low, which is fascinating. So, all
By the
right.
way, Samsung's up 146.69% year to date in Korea on their
Oh,
exchange.
is that good? Is that good? Should we
Yeah.
like that?
I
That's
mean, I think there's a lot of people there that are happy. So a lot of people with employee stock options and or shares that are probably very happy. And it's like you said earlier, the people that work for companies want their company listed most of the time. So, they can actually get paid for owning a bit of it.
all right. Last thing we'll do is NASDAQ percent change after release of Netscape to .com high, which was March 10th of 2000. So it's basically December 94 to March of 2000 versus the release of ChatGPT. So Jay used to hate these charts, but basically you trace over. So you have that period since the Netscape release. So Netscape, if anyone doesn't know what the heck that is, that was the first browser. Like that was a big deal. Like, oh, Netscape IPO. I have to look at the S1 of that one. That would be a fun one to look at. And then, nobody used Netscape after that. But they basically traced on this chart. So you have ChatGPT through 875 days. And then that only would have gotten you in the same period to, I'm going to call it like June, July of 98. So then you had, that period, and then it finally tops out in March of 2000. So you look at Netscape, ChatGPT through 875 days, basically up plus 144.55, plus 144.77. Liz Ann Saunders had tweeted out, I think she said, wow. She retweeted this chart from Bespoke Premium. Yeah, like this is kind of interesting. It's the same. Like the NASDAQ is up basically the same percentage from the release of Netscape, the release of ChatGPT to date, which is 875 days ago. It's interesting.
I am interested to see how it plays out. It who knows with fractals, right? This is a pretty solid fractal, though. I would say this is probably 90%, 85, 90% of it's fitted perfectly. But wouldn't you argue that based on looking at this, we're probably still in the third or fourth inning here of this AI trade, right?
Well, that's what I was trying to figure out. Like, how much more did it go up? And I think the answer is about 360% more from here.
Yeah, over what, 2 years, year and a half?
Less than. Well, yeah, no, just about a little under 2 years. Yeah. So, if you look at this chart, you would say the market kept going higher, but at some point you had this real acceleration. Like, look at the end of 99 into March of 2000. You had this parabolic move where the NASDAQ goes from like 250 to 600, something crazy like that. And then obviously it came back down. So, yeah, I mean, there are people who are critical of these charts. My old co-host Jay used to hate these. I think he hated them. Maybe he hated one of my other charts. But it's kind of uncanny. It's the same.
I'm a fan of fractals. I like fractal theory. Benoit Mandelbrot, chaos theory. I like that stuff in markets. It might not fit perfectly, but it often rhymes, right? And so far, I mean, I think we're seeing it's pretty much sticking to the Netscape move so far. So,
by the way, Netscape in their S1. So the S1 is the document that gets released when a company is going to go public. So their revenues. Okay, so 1995. This is revenues. This doesn't say millions, so maybe it's 4.7 million. And then if I look at, they lost 2.7 rounded million in 1995. And then so April 4th of 1994 through December 31st of 94, their revenues were 695,000 and they lost 8.5 million. So there you go. I love looking at these old S1s. It's great. I'm telling you, have you looked at I said this last week, how like, what's the right word? Like it's a gorgeous pictorial, the SpaceX S1, like the pictures in there of the rockets and everything. I'll send you this one, Shane, or you can look it up. You can just look it up. Like there's no pictures in the Netscape S1. It's just all like a dry legal document. But now these things are like, really, really kind of, going for it. Let me look at their risk factors in here. If I can do this quick, if not, I'll just do it another time. So risk factors, page 5. So think about you have an internet browser and you're basically going to come through here and say, okay, what are my risk factors? Oh, I can't find it. The pages aren't perfectly aligned. Like what were they going to say? That the internet may not be a thing? Or they might be other browsers, wink, wink, Google, that come along. That was kind of a big deal. So this is where if I'd planned this, I would have run this through like Claude and had it summarize the thing for me in like 2 seconds rather than me reading it.
I think we should do a SpaceX breakdown next week with Mike coming back, or the week after when Mike comes back, and like you said, do a little something for it.
Oh, we just need to take some totally dumb predictions on it.
Yeah. Oh yeah. I like it.
I think we should, and we should just make some predictions and see, what we think. Let me see. What were here, I'm putting this into ChatGPT. What were the risk factors in Netscape S1? Let's just see if they, because pets.com, this is somebody scanned this. All right, I'll drop this. Let's go to recommendations.
I got nothing again, man. I've been dad a lot. We've been, doing the whole wife goes to work, right, when I get off, and I'm with him the whole time. But we've been to the local library often, so I guess I'll throw that out there. Go to your library if you haven't recently. And it's almost time to start taking him fishing. So gonna get.
Oh, okay.
Yeah.
Is there like a starter? I don't remember what we did with my son. I think there was a starter fishing pole.
Yeah. There's like, pretty decent sized ones. It's like safe. If anything big catches it, I'll just make sure I have to, you got to be next to him, right? You never know. But it's, he's been wanting to go really bad. And my dad lives by a pond as well. And so we've decided we're going to get him a set.
I feel like when my son was little, it's all about the little tackle box. Like it didn't matter the fishing. It was like having his own little tackle box and then just
all the
having
stuff
gear.
Yeah, exactly. No, it's a total, it's all about the stuff and way less about the fishing. You got to have a bobber, right?
Those are important. And the weights, I think at one point he had put like 10 weights on the line. I don't know, like he was deep sea fishing.
Right.
I'm sure that went right to the bottom of the thing. So, all right. So I watched I was on a plane and I watched a couple things. I would say that, all right. So I rented the Ryan Reynolds movie. What's the one where he goes to space? I just watched this.
Life. Was it Life?
Oh no, I'm thinking of another one. What's the? No, it's not Ryan Reynolds.
Matt Damon?
No. It was. What is? It tells you how memorable
Is it
this thing
Ryan
was.
Gosling?
Yeah, Ryan Gosling. There you go.
Was this the one where he works with the alien?
Yeah. No. Yeah. I mean, I got to be honest with you. So I didn't finish it, and then I guess my rental had an expiration because I rented it, and then I didn't watch it. You have so many hours once you start it, so I never finished it. It's not quite a sell, but it's a hold. And the reason why, like you already knew what happened because they just kind of cut to the chase, and then there's all these back. You look back, and I was like, I don't think this is very good. I'm sorry. Maybe I need to watch the whole movie, and I'm not being fair to it. I think it could be an underweight here. It's an underweight.
It's tough when you know what's coming, especially if they just give it away. It's hard.
That's the way I felt. What is the name of this movie?
Project Hail Mary.
Yeah, Project Hail Mary. And the trailer looks really good. And the Rotten Tomatoes score is really good. I think I'm using the Goldman Sachs weightings here, or the rankings. I think this is an underweight.
Yeah,
it's an underperform. Yeah. Is my ranking here. So I'm sorry, Ryan Gosling.
I'm still convinced that Space Odyssey it's hard for me to like anything more than that one when it comes to space films. I mean, you've got a lot of good ones. We watched.
Well, The Martian is by the same author. So I believe it's the same author or same screenwriter. I believe it was a book. Both of those are books. And I thought The Martian was great. Matt Damon's in that.
Yeah, that's the one. That's the Matt Damon one I was thinking of.
So there you go. If you're looking for something, if you haven't seen that one yet, check out
Ridley
The Martian.
Scott. Story by Andy Weir.
Yeah, so I think that's good. All right, we'll come back next week and see everything we got right, everything we got wrong. Until then, that's it. Be well, everyone. We'll talk to you next week.